Hello, everyone. Welcome back to our series on estates, gifts, and trusts. I am Bruce Van Brady, Director of Marketing with Brady Ware, and I'm here with Mark Kassens. He's in charge of our estates, gifts, and trust practice. Mark, we've been covering some other subjects, but today we are talking about SLATs. Can you tell us more about that and maybe start with just what that even means?
Sure. So a SLAT stands for a Spousal Lifetime Access Trust. So this trust is an irrevocable trust that's created for the benefit of the creator's spouse during their lifetime and to their remainder beneficiaries. It shifts assets from the donor's estate and is able to use their lifetime exemption.
Got it. So, why a SLAT? When would somebody want to employ this type of trust?
Yeah, it's a vehicle to, like I said, use their lifetime exemption before it resets in 2025. So that's kind of why they're more popular now than they ever have been. They keep the access to the assets in the marital unit, and because the spouse has access to it. It's similar to a credit shelter trust, but it's funded while the donor is still alive. It's not part of a living trust that splits up when they pass away, and it's not intended to qualify for the marital deduction. So it will not be included in the spouse's or the surviving spouse's estate either. So it's irrevocable. Once you set it up and fund it, it cannot be changed. So you're stuck with it after it's funded, which can create problems in cases of divorce. So if there is some off chance that the marital unit is going to fall apart, especially soon after this trust is set up, you need to have language in there to define what your spouse is, and that can be done. It's not just um, a kind of a no win situation in that case. You can't have language for that, just in case the unfortunate happens. So this is a grantor trust for tax purposes. So all the income is taxed to the grantor. It's basically ignored for tax purposes. So the grantor pays the income tax on it. But again, in the case of a divorce, that falls back on the grantor. So the spouse is living high on the access of the trust, and the grantor is the one paying the tax bill. Um, you have to have a trustee like you do in other trusts. The donor spouse really shouldn't be the trustee. They can be, but it creates other barriers that you have to put in place and restrictions on distributions and such. So it's really better to have an independent trustee, and the donor should not be the trustee either. That really is a problem. It's just not allowed. So then, when you do these, I was saying, well, how can you lose? My spouse gets access to this, and why don't they just do the same thing for me? And then really nothing changes. You really can't do that. And the IRS has a what's called a reciprocal trust doctrine that allows them to basically ignore the trust, and then all those assets would be back in the estates. So you really don't want to fund identical trusts, one right after another, to kind of just make it false language. I mean, it's really just don't do it. What you need to do is have the trust changed in some way, or not changed, different in some way. So the beneficiaries are different, or the distribution rights are different, trustees are different, and also there should be a lapse in the time between when they're created. If you're doing it, on the same day, that just doesn't look good, and the IRS won't look upon that very well either. Let's see, what else do we need to talk about? So what if you don't have enough assets to really fund the trust? The marital unit it might be all in joint accounts, or most of it in joint accounts. So how do you move it so where I want my spouse to set up this lifetime access trust, but they don't own anything? Well, if you gift that stuff to your spouse, and then turn around and kind of put it into the trust, like it just happened in one step, the IRS can also basically say, you know what, that intervening step didn't happen. It's called the step doctrine. So there has to be time between the gifts when they're made to the spouse to fund kind of their estate before they fund that trust. Because if you don't, then the IRS can basically disregard the whole thing. So again, there has to be a time lapse in there. There has to be some aging of the assets under the spouse's control, sole control, not under the joint control. I think that's probably those are the big things with the SLAT. I mean, they're really a neat vehicle for using this lifetime exemption. And like I said, I mean, these have uses outside the lifetime exemption, but this is the really big push now to use that almost $13 million before it resets to $6.5 million a few years from now.
Okay. Well, give us an example. What kind of impact are you seeing with SLATs?
Yeah, so like under current law, the lifetime exemption is $12.92 million. So you have almost $13 million of assets in your state. And let's assume that grows at 5% over the next couple of years. Okay. So then we pass away in 2026, and that net worth has grown to $15 million again at a 5% growth rate year over year. So let's assume that we didn't do anything and we have all that $15 million in our estate. That lifetime exemption, let's say it's back down to $6.5 million. It might be a little bit more than that a couple of years from now. It depends on inflation in the next couple of years. But let's say $6.5 million. If we had that $15 million in our estate without using this vehicle or another similar trust that can move that lifetime exemption out, that tax would be $3.3 million. That's pretty substantial. So it's 40% highest state tax rate, and you get to the highest rate after $1 million of a taxable estate. So instead of moving $15 million to our beneficiaries, to our heirs, we've moved just under $12 million. And all of that, $3 million has gone to the United States Treasury. So it's a pretty impactful way to move that much money. And it really makes a difference. And all it takes is a little planning. You have to have these thoughts in mind. You have to have the documents in hand. You have to have it funded. But a little planning goes a long way. $3 million on just a $15 million estate is pretty substantial.
Definitely is. That's definitely a pretty strong impact to set this up and to implement it and to have it done correctly. Thanks again, Mark. Thank you for walking us through the SLATs. We'll be back with another edition of as we work our way through the states, gifts, and trusts and the trust series, and just talking through what benefits they have for you. As always, feel free to reach out to us if you have any questions. And you can reach us either on Mark Kassens' bio page. You can email him directly, or probably the easiest is just hit the contact button in the upper right of our website and send us a message, and we'll get back in touch with you. So thanks again, and look for our next edition coming soon. Thank you.